A client, a US citizen, wanted to invest $250,000, which was sitting in cash doing nothing in a bank account. After a detailed fact find of his financial and tax position, we realized that actually his priority was being up to date on his US and Brazilian tax returns. He was holding some investments that could be classified as PFICs. PFICs are passive foreign investment companies which can potentially attract capital gains tax of up to 50%. In fact, many US citizens around the world hold PFICs without knowing it, such as mutual funds or insurance policies outside the US. They don't understand the risk of doing this. The priority in this case was having both of his Brazilian and US tax returns in sync, fully up to date, including the rectification of past errors. Both jurisdictions, in fact, have demanding and detailed reporting requirements. For instance, FATCA, which is the Foreign Account Tax Compliance Act, makes it compulsory for all US citizens to declare all overseas assets on their tax return. We consolidated the PFIC investments with the original cash balance using a US compliant asset manager based in Europe. Another advantage of this exercise was greater geographic diversification in his asset management strategy compared to a typical US-based asset manager who would typically invest most of it into large cap US stocks. Another advantage of this was greater geographic diversification in the investment management strategy compared to a typical US-based asset manager who would go for mainly large cap US equities.